It's very important to realize before 1933, one did not purchase gold. One redeemed one's bank deposit, which is a contractual obligation. When you deposited the gold, you had a right to get your gold back, which forces them to shrink their balance sheet. The shrinking of the bank's balance sheet was at the sole discretion of the depositor, not of regulators, not the bank saying, well, we think we should shrink our balance sheet today. No, it was the depositors that imposed that discipline.
Hi, I'm Kaiser Johnson with Liberty and Finance, letting you know that as brokers for Miles Franklin, we can help you secure your future with precious metals for personal delivery, vault storage, or your IRA, with some of the best prices in the industry and privacy, security, and personal service that no one else can match. Our number for all orders and questions is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're delighted to have this distinguished returning guest. Keith Weiner is the CEO of Monetary Metals. He joins us this Friday, October 21st, 2022. Keith, thanks for coming back on.
Thanks for having me, then again.
Our audience has been, and I have been, uniformly impressed over the last several visits we've had with you with your depth of knowledge and education and understanding and grasp of sound money, Austrian economics, common sense, logic, a lot of things that are missing in our world, and that's why it's a breath of fresh air every time we get a chance to talk to you. I understand we're reaching you in Switzerland, where you're on business travel and so on, so grateful for you taking the time. It's your afternoon, it's our morning here, but grateful for you taking the time out to talk with our viewers. And we've got some specific things we'd like to dig in with you about, and hope we can. The first is a article that came out just yesterday announcing this is, and I'll put a link to it in the description of this video. The article is on a fragile treasury market is at a risk of large-scale forced selling or surprise that leads to a breakdown, Bank of America says. We talked with market trader Gregory Mannarino about that yesterday, who alerted us to this development, and you and I just spoke about it as well. In the series of unfortunate events that our U.S. dollar, our U.S. Treasury, and debt markets have gone through over the past several decades, what do you see that was sort of the setup that led to these kinds of vulnerability and risks of illiquidity and of dependency on things going all right, because they say they list a whole bunch of different things that could go wrong that could cause serious trouble in our treasury and bond markets. Can you talk to us about why we've kind of been in a setup all these years and how this might in fact, whether you think this is in fact a credible risk at the current time?
So, interesting question. And if you and your audience will bear with me, I'm going to have to take a fairly big step back and kind of broaden the scope to give what I think is the minimum viable answer to that. And so this is the setup to this is something I discussed in my theory of interest and prices, and that is the lower the interest rate. So we have a too low interest rate, which is a separate and distinct problem of a falling interest rate. But when the interest rate's too low, it is both the enabler and the motive for taking on leverage. It's the enabler because leverage is cheaper, right? So the cheaper something is, the more the incentive is to do it. And it's the motive because the lower the interest rate is, the less return anybody can get on capital, just straight up capital. So you need leverage as a kicker to make your nut. If you're running a financial institution, you have all of the compliance costs, administrative costs, sales channel costs. You have to pay the traders and everybody else. There's a basic cost basis to be in business. And, for a very long time, the interest rate structure has been too low for covering all that cost, let alone a profit. So they have to lever up. And levering up involves many different things. It's not just simply, borrow money and you're good. In a lot of cases, it's pledge something like, so you own some treasury bonds, let's say, and you pledge those as collateral in order to get the cash you need to fund whatever it is you're trying to do. And that's a form of leverage. Well, as interest rates rise, The irony to the headline is, of course, the Treasury bond market is the least marginal debt market in the financial world. Everything else will blow up before the Treasury bond does. So to say, the Treasury is going to blow up. No. The Treasury is going to blow up because in the process of everything else being blown up, hedge funds, for example, but a lot of others, as we saw in the UK, even pension funds, getting into these. So I did a talk at the New Orleans Investment Conference on how to build and destroy a pension fund in 22 easy steps. And one of the slides was a picture of Eve going for that apple and the forbidden fruit, and that in a pension fund, leverage to buy risky assets, including equities, really should be forbidden fruit. I'm not necessarily in favor of a law or regulation, but a sound pension fund isn't betting on equities.
Yeah, at least transparency so people know what they're getting into. Rick Rule chided me last time I had him on because I was complaining when my wife and I were trying to do risk off and seeking safety after the .com bubble had collapsed, and we don't want that to happen to us again. So we got out of stocks in our brokerage account. It went into a money market cash equivalent fund called the Reserve Fund to get 2% interest and one day access to our funds until the 2007-2008 global financial crisis with Lehman Brothers, et cetera. We got a notice from TD Ameritrade saying, until further notice, your access to your funds has been suspended. And we called them up and they said, well, it's because of the Lehman Brothers. I said, no, we weren't invested in anything funny, any stocks, bonds, or leveraged anything. We were just in this money market fund. They said, well, your money market fund on the backside, in order to make its margin and so you're collaterally damaged. So I understand exactly what you mean. Transparency would be the key, if not a rule, at least a transparency.
I think the attraction, right, if you look at the debate between, this is a total side rabbit hole, but the debate between, so-called defined contribution plans like 401ks and IRAs versus defined benefit plans is all about, people don't want the transparency. They want an opaque balance sheet and just a blanket promise that we're going to pay you $3,500 a month forever when you retire. People are like, yeah, that's great. And they don't want to know how the sausage is made. They don't want to know what's on the other side of that. And then when it blows up, they say, oh, those crooks, they should be put in jail. And they don't understand the entire financial system is wired in a way to destroy pension funds, the falling interest rate. I can go off at length about that if you want, but that just destroys pension funds in particular.
Well, that's one of the concerns a lot of people have right now because of being late career stage, baby boomers aging, retiring, very concerned about their future. So let's circle back to that. And you were taking us on a exposition of how it is that so many derivatives have been developed because of these various institutions trying to make a profit in a environment that's challenging to make a profit.
Right, and so they're forced to lever up, and one of the ways you lever up is you pledge some sort of asset as collateral to get to borrow funds, and then of course you can do that over and over again. You can take that asset that you just bought and pledge that as collateral, and that lower the interest rate. The more you have to do that to make your nut. Anyway, so when interest rates rise, then suddenly cost of funding rises, the value depending on what risky assets they bought. I mean, if you think there's a bloodbath in treasuries, you should take a look at, other assets. And so suddenly, you're forced with, okay, in order to hold that position, you have to, put up more capital. And in some cases, the assets they bought are illiquid. They can't really be sold. So you have to find something else. And so ironically, and the same thing is happening with gold, ironically, the highest quality asset is the one that isn't subject to a bid-ask spread that's 80%. It has a bid-ask spread that's tight as it should be. And that's the thing that's easiest to sell. So ironically, people are selling the highest quality asset in order to hold the lowest quality asset. Because if they try to sell the lowest quality asset and the bid-ask spread is 80%, they're taking at least an 80% write-off, and then suddenly they have to reveal on their books they're insolvent. And nobody wants to admit they're insolvent, even if they are. So they play this game. So you can have all this forced selling, Now, a point that I make, I think what I just said up until now is not in any way unique to me. I've read analysis along these lines from other people. I mean, I think it's smart analysis, but I don't think it's unique to me by any means. What I'm about to say is unique to me, and that is there really isn't any way. Like when people think, okay, selling treasuries, you get dollars. When you sell something, you get dollars. And that's true if you sell a bottle of beer. That's true if you sell a car. That's true if you sell any, a stock even, dollars are deposited in your account. But you think about selling a treasury for a minute. There is no way to sell a treasury and be out of the loop of funding treasuries. No matter how you own a dollar, you are funding a treasury one way or the other. If you own a dollar bill, which on it says Federal Reserve note, you are owning the credit issued by the Federal Reserve for purposes of funding its portfolio of treasury bonds. Or you can deposit in a bank, and the bank is funding the treasury. That's part of their business model and part of what the regulators require banks to do. Or if you don't like either of those options, and especially if you're a big, multi-billion-dollar holder of cash, you wouldn't generally hold cash, you would hold treasury bills. So a dollar is a thin slice of the government bond. So to say that there's going to be a selling off of bonds and there are no buyers for treasury bonds is kind of a contradiction of how the system is wired. Now, this is thoroughly dishonest. This is the real evil of President Roosevelt's 1933 gold. Everyone's aware that he confiscated gold, and that was certainly not a good thing. I'm no defender of that. But the real evil of it, the much greater evil, is forcing everybody into treasury bonds and making the government debt the root monetary instrument of the whole thing. A dollar is a thin slice of the government's debt. So to say, well, where are we going to have buyers of government debt is kind of a contradiction in terms. It's saying, are people going to refuse to be paid in dollars? Is anybody going to go to their boss and not ask for a raise, but rather ask not to be paid in dollars? Yes, we will come to that point. I love to quote Aragorn from Lord of the Rings on this. The day will come when men reject the bonds of the U.S. government and the U.S. dollar. But today is not that day. We're not at the point where people are saying, I don't want dollars. We're still at the point where even the gold bugs think that the dollar is money. And even Austrian economists will argue with me, both on Twitter and in academic context, that no, the dollar is money. Money means the dollar. And gold was money, and maybe gold will be money again, but gold is not money right now. The dollar is money. We're still at that point. The dollar is not being repudiated. In fact, if you look at the dollar index, we're now, making new highs almost every week. And the dollar index, all the other paper currencies are going over the edge. And all the other paper currencies are dollar derivatives anyways. So getting back to, we obviously have had a rise in interest rates in the U.S. The Fed controls, as in a central planner, diktat, D-I-K-T-A-T, issues diktats for what the overnight funding rate should be. That is simply controlled by a central planner, imposed by the way imposed by the government is imposed by force. They just dictate that, and you will like it or else. But the longer you go out on the maturity curve, the less control they have. So what they have done is they've pushed up all interest rates, but they've pushed up the most the short interest rates, and so they've inverted the yield curve. So one of the problems that occurs as a result of that is that, and again, this long, I wanted to take that step back and talk about the broader thing. So we've had a falling interest rate for 4 decades, since 1981. And so I mentioned, and I'm going to tie this all together, I promise, that both enables and incentivizes everybody to lever up and in perverse ways. And one of the perverse ways, when people realize you're in a falling interest rate environment, you do not want to take long-term liabilities on. You don't want to borrow 10-year or 30-year maturities. You want to borrow very short maturities, let's say 1 year, and you count on rolling them over, or even shorter. You go to the commercial paper market and do 30-day or 90-day, and that's what the money market fund that you're in invested in commercial paper, which is supposed to be safe. But the issuers of commercial paper were abusing this privilege, and they were issuing 30 or 90-day paper we should be refunding essentially receivables for, mostly consumer products. And instead, we're buying long-term assets. So if there was a demand for redemption, i.e., we're not going to roll at the end of when your paper matures, then they have a real problem. They just assumed that there's a God-given right that the market is going to guarantee them that anytime you want to roll the liabilities, you can roll the liabilities. In 2008, said, no, not going to happen, not this time. And then anybody who couldn't roll or couldn't delever was creamed. So, but everyone has to borrow shorter and shorter maturities, because every time the interest rate falls, you don't want to be the sucker who's now committed to a higher rate of interest in borrowing, and therefore at a disadvantage competitively to your competitors. You're the schmo with a 10% loan, everyone else is at 3%, you're dead. You can't possibly, and I've written a lot about this, everyone borrows at shorter and shorter maturities, and that's what makes this hike in interest rates all the more painful. So the interest rate goes up. If you're on short-term liabilities, short-term funding, you're using whatever 30-day or even 1 year. As that rolls over, your funding cost is going up as soon as it rolls. So the rate hikes hit you immediately. However, the assets that you already own, they're not paying anymore. That's a contract fixed for them, for the duration of that asset. However, the market price of the longer-term assets is highly sensitive to interest rates. Interest rates up, asset prices down. That is a strict inverse. That is a seesaw. This is going up. That is going down. And so suddenly the Fed is like, hey, we'll push up interest rates. Asset prices going down. So you're getting hit both ways. You're getting hit in the cash flow. You're getting hit on the P&L that your funding cost just went up. And you're getting hit on the balance sheet, your assets going down. So there's this forced deleveraging. And so if you can't sell, so if you've put up, treasury bonds as collateral to finance some other sort of asset, you can't sell the other asset, you can sell the treasury bond. So you get all this forced selling of treasury bonds. However, I note for all of this forced selling of treasury bonds, the 10-year treasury is very close to inverting with even the 3-month bill. So the 10-year treasuries have not sold off as much as they should just to keep a normal yield curve. So now this gets into kind of the bowels of the banking systems. You have all this selling of paper. To raise cash, the cash is deposited in the banking system, and the banks, in theory, are going to turn right back around and buy treasury bonds again. So you get this disruption. No bank is going to want to stand in front of the steamroller that's of selling. They're going to want to wait on the sidelines, at least until that is over. There's two things that both enable and force that to happen. One is the Fed is paying very generous interest rates on reserves, including excess reserves. So, the regulations normally used to require the banks to have a certain reserves. They weren't paying any interest on that. And then beyond that are so-called excess reserves. The Fed is paying generous interest rates on those reserves. Number two is the Fed is offering the banks the ability to reverse repo the treasury bonds. So instead of buying the treasury bonds, you can rent it and get essentially the same yield. So the banks are not necessarily in any rush to buy these treasuries while the price is still subject to downward risk. They're just piling up more and more cash and waiting for the opportunity. And then you have all the various regulations, including Basel and including Dodd-Frank, that force the bank to be more and more restricted on what it can do on its balance sheet. The banks are more and more restricted, and that impairs to some degree their ability. However, the net upshot of all of this is that when this forced selling press, so forced selling is a finite duration thing. That's not, to have a genuine rising interest rate cycle, there has to be a cycle. There has to be something that keeps, the higher the interest rate goes, the more selling there is, and the more as the borrowers are ultimately bidding up and chasing up the interest rate all the way to whatever, 15 to 20%. But, forced liquidations is kind of a short-term crisis. And when it's over, there is going to be an absolute rip-your-face-off rally in treasury bonds, which means the price of treasury bonds rising, the yields on treasury bonds falling, and if the short-term if the Fed hasn't pivoted by then, and I think the Fed will be forced to pivot anyway, which is another discussion, then you'll just get a greater and greater inversion of the yield curve, when this happens. So right now you have this setup. I don't necessarily agree with Bank of America that this is a crisis and the Treasury bond market is going to be in turmoil and disrupted and, threats of the dollar and all that. I think this is just the gyrations of where interest rate hiking policy meets some very perverse regulation. And, you get this unique witch's brew that's boiling over at the moment, or potentially could boil over. It boiled over in UK gilts. Arguably hasn't really boiled over in Treasury bonds.
You mentioned along the way there banks resisting being forced to give up liquidity or any institution not wanting to have to part with the asset side of its balance sheet because it would reveal how dependent they are on sort of this leveraged house of cards they've got, and that's taking like the base out from underneath that house of cards. We've had numerous reports, more than ever before, from clients, small-time clients, medium, and even some very significant ones, billionaires, who have encountered unexpected resistance from the banks when requesting to wire money out of the bank in order to buy precious metals. That phenomenon, you could look at it just as, well, it's a competitive threat to any business. If someone says, I'm going to take some of my liquidity out of your institution, go use it for something else that's outside the system, and therefore it's not beneficial to you anymore because now I'm going off to a different playing field and not in your wheelhouse anymore. But is there potentially more to it than that banks are actually concerned about an existential threat to their viability or their liquidity, that sort of thing, or their solvency, if this gets to be like a run on the banks, people wanting to withdraw their cash in a way that's real and get it into something that's completely outside the system?
So the meaning, nature, and consequences of the 1933 Act was there can't be, the only way to have a run on the bank, and you can't run on the banking system at all because the dollar is self-referential, right? The dollar is backed by the Treasury bond, which is payable only in dollars, which is backed by the Treasury bond. So it's a scheme between the Fed and the Treasury. Brilliant. I mean, evil, but brilliant. There can't really be a run on the banking system. There can be a run on the commercial banks, but only if people are withdrawing paper notes. So if you want to buy precious metals, you just wire funds to the precious metals dealer, and it's going into his bank account. And so is there really any net flow from one bank to another? I mean, if I bank at Citi and I want to buy from a precious metals dealer who has an account at JP Morgan, there's a transfer of funds from Citi to Morgan. But you may bank at Morgan and buy from a precious metals dealer who has a banking account at Citi. And so there really isn't necessarily any net flow. Any one bank is losing share per se. That these things net out over the entire banking system. So, it's very important to realize before 1933, one did not purchase gold. One redeemed one's bank deposit, which is a contractual obligation. When you deposited the gold, you had a right to get, which is a loan agreement, essentially a credit to the bank. You had a right to get your gold back, which forces them to shrink their balance sheet. The shrinking of the bank's balance sheet was at the sole discretion of the depositor, not of regulators, not the bank saying, well, we think we should shrink our balance sheet today. No, it was the depositors that imposed that discipline. Today, or after 1933, the dollar is irredeemable, and particularly after 1971, to make the point clearer, the dollar is irredeemable. When you buy gold today, it is simply two third parties to the banking system, the third parties exchanging, I have dollars, you have gold, and then I give you the dollars and I get the gold. And so now we've swapped positions. But there's no real change in the banking system other than they changed the name on the record of those particular dollars. And of course, now I'm holding the gold in my pocket versus your pocket. But nothing really changes. There's no effect on monetary policy, no effect on the banking system. It is not a competitor to the banking system. That's why Roosevelt did it. And that's why after 1971, when they made the dollar irredeemable even to foreign governments and foreign central banks, they kind of debated for a bit. And then eventually when Jim Blanchard, do you know the story? Is this worth relaying?
Go ahead.
So Jim Blanchard was a paraplegic and used that fact, I think, very effectively, showing up at the steps of the Capitol in a wheelchair, holding up a gold bar, and saying, this isn't a gold bar, this is my business card holder, which is made of brass or whatever, but, I'm a cripple. I dare you to arrest me. It is illegal for me to possess this. And he really taunted them. I think he hired an airplane, one of those, to drag the letters behind that says legalize gold now. And he generated a lot of publicity. And he's one of the good guys who really fought a good fight. And in 1975, they re-legalized it. And at the time they re-legalized it, they thought, well, gold is basically dead as a monetary asset. And now we'll let it go on the futures exchange and trade like frozen orange juice and pork bellies. They thought they were just demeaning gold, throw it into the mud with the pigs, as it were. They didn't care about it anymore. They didn't have to care about it anymore because by the wiring, by the design of their system, it didn't have any effect on anything anymore. It didn't matter anymore. And so if you buy gold today, now it doesn't have any effect. That said, at the same time, you have all this going on. You have this non-monetary force called compliance, and particularly so-called anti-money laundering, know your customer, AML KYC compliance, that anything that touches the word gold is deemed to be high risk from a compliance perspective, and banks can be called before various regulators, including FinCEN, but in addition, all the other regulators can look at as well and say, are you doing all the appropriate compliance things? And anything that touches gold is deemed high risk of, being able to use to fund, narcotics and terrorism and child trafficking and all the stuff that, people think are bad. There's something really perverse here, which is every time a bad guy gets caught doing something, there's the public has this knee-jerk reaction to say, blame the bank. Why did and Citibank had this guy as a client? And there's all this backlash against the banks, which has resulted in all this regulation, which makes banks more and more reluctant to do anything that can enable money laundering, which also happens to be most of the things all of the things that people that are liberty-minded are thinking about, like withdraw cash, deposit cash, buy gold, like all the things that, people care about and from a liberty context are now deemed to be high risk, as one could either say collateral damage, or one could say, sir, that's not a bug, that's a feature. That is indeed the point of all this AML KYC stuff. But you get caught in the crossfire of it, and the banks are increasingly reluctant to serve as a conduit for those transactions.
One more thing you didn't mention there, I thought you might, was that it's been certainly alleged by many students of history that the government themselves, including a lot of the three-letter agencies and so on, have been arguably the largest traffickers in some of those items that they're trying to ostensibly to squelch, criminal activity, and which resulted in airplanes full of cash being flown over to Europe not that long ago, or gold being held in a whole bunch of small banks down near the southern border, et cetera, et cetera. So,
yeah, I mean, a little bit outside my wheelhouse, but there's no question there's been some pretty famous incidents of either the president or the CIA deciding that they can do things that everybody else would, be deemed to be unacceptable or criminal, but it's okay for them to do it. And, that's just the degraded state to which America, once the, shining beacon of liberty, has degraded itself.
Could we, just before we leave that topic, press on a little bit farther, because a lot of those activities that people want to do who are liberty-minded, to have tangible asset that's not owed to anyone else, the fruits of their labor that they can hold in their hand for future needs or opportunities, the privacy to transact with and where and when that they preserve without being traced and tracked and told yes you may or no you may not, mother may I from the nanny state. A lot of those things that people want to do, because those are by natural law and by historical tradition rights of the individual, were absolutely advocated and were some of the reasons the nation of the United States was founded. Our founding fathers were trying to break free from the clutches of central banks in Europe that were inhibiting and restricting and prohibiting and oppressive governments and so on. Can you touch to us for a moment on that? How is it that being like our founding fathers makes us like criminals in this current upside down world that we're living in?
Well, there's the word upside down, right? Good is bad, right is wrong, dark is light. The only thing, I agree with 100% with what you just said. The only thing I can add is, I think it was John Adams, when they were debating some sort of income tax, and had written that, it was totally unacceptable because of the intrusion into the private affairs and letters of the people that such a tax would necessitate. And I'm not getting the wording exactly right, but I remember the phrase intrusion into the private affairs and letters of the people or of the citizens or something like that. And so at that time, that was absolutely rejected on that grounds. It wasn't, well, it's not efficient. It wasn't, well, how much, can you afford? How much blood can you tap out of the veins of the goose that lays the golden egg while still keeping it laying golden eggs? It wasn't, like a Laffer curve kind of argument. It was like, that would be intrusive. Like you'd have to have a government agency that was looking into people's affairs and letters, which is totally unacceptable. The post office, of course, operated from day one on the idea that when you wrote a letter to somebody, that was your private letter, and you were expected to put it in an envelope that made it opaque. They couldn't be reading your message. And, we take that for granted. We take that for normal. And then, nowadays, a lot of people would say, well, if you don't have anything, if you're not committing any crimes, you shouldn't have to worry about hiding what you're doing. I forget the phrase they say. If you're not doing anything wrong.
If you have nothing to hide, right.
Right. And it's like, wait a minute, there shouldn't be a presumption that privacy is hiding in a sense of, concealing something that you, the state, have a right to see. And by using encryption or whatever, that I'm withholding something that is rightfully yours. The presumption should be the opposite, but everything's been inverted. The idea of innocent until proven guilty has been inverted, particularly in the regulatory state. Not only are you presumed to be guilty, you have to prove your own innocence constantly at your own expense. And so-called anti-money laundering KYC regulation, you have to prove that your customer is innocent at your own expense and your own liability. And if your customer turns out not to be innocent, or even in the future commits a crime, you actually, as a financial institution, potentially have severe liability for the actions of your customer. And as far as I can tell, the majority of people go along with this. And every time some bad guy gets caught, they want to blame the financial institution as much as they blame the bad guy. Like, you should have made it impossible for him to do that. Well, think through what that really means for Citibank to make it impossible for somebody to, traffic in children, versus why don't we just go after the people who traffic in children and leave the damn bank out of it? I mean, if somebody takes mass transit, takes a train to downtown and then takes out a gun and starts shooting people, we don't arrest the train driver and then fine the railroad company $1 billion and say, well, you didn't know your customer. We just say, well, he's a murderer, right? Let's arrest him and let's stop the murders rather than let's stop the mass transit. But in banking, that seems to be the philosophy. So yeah, it's all upside down.
Yeah, there's a lot of that transfer of responsibility and infringement on freedom and privacy that's been happening just rampantly. And if after you've been through that cycle enough times, people stop thinking critically about it and asking those kind of questions. You ask, like, wait a minute, why does that even make sense? Certainly, Second Amendment rights is a good example of that, and others where rather than directly trying to oppose the conduct that's unacceptable in a civilized society, there ought to be a law. There ought to be a law. There ought to be a law. And pretty soon you're drowning in this sea of where you no longer have your privacy, you no longer have your freedom, you no longer have the ability to be a free person. I think it was G.K. Chesterton that says, if people start ignoring the big laws, what do you get? You get the little laws. And there's that impulse that we have of somebody ought to do something, there ought to be a law. I often say the same thing: be careful what you're asked for. I wanted to circle back to something you brought up earlier about retirement risks that people are facing, people who are late career stage, or maybe they already are trying right now to retire, or maybe they did retire and then COVID hit. Now they're wondering whether they have to go back to work because they can't make ends meet with inflationary costs going up more than their income was and that sort of thing. Retirement funds have been between a rock and a hard place for a long time. And can you talk to us about the risks that, whether it's private pensions or whether it's municipal funds or union funds, that kind of thing, why this is a big deal and it's going to affect a lot of people very soon if it hasn't already?
If you think about the balance sheet of a pension fund, and now I have to appeal to the idea of honest accounting versus all the rules. Every time there's a crisis, they change the rules of accounting to paper it over, right? So after 2008, in the spring of 2009, I think this marked the bottom in the markets. They said you don't have to mark your asset to market anymore. So you have an asset that's only worth $40, but you still keep it on the balance sheet at 100 because, hey, they changed the law and the law makes it all good, right? So if you think about a pension fund has liabilities to pay out many decades going forward. And so there's a pretty well understood concept, certainly to accountants and actuaries, which is net present value. You say, okay, if I have to pay you $1 right now, what's the value of that liability? It's $1. If I have to pay you $1 next year, what's the value of that? Well, it turns out it's discounted by some discounting factor, which is the market rate of interest. So if the interest rate's 10%, then my liability to pay you $1 a year from now is actually only 90 cents. And now if I have a liability, an obligation to pay you $1 every year starting next year out into perpetuity, you can begin to see how discounting really matters. So what is the net present value? Well, it's $1 now plus 90 cents next year plus 81 cents, 0.9 times 0.9, 2 years from now, 72 cents the year after, ... That is an infinite series. Mathematics tells us the sum of this series is 10. So if I owe you $1 a year forever, and the interest rate is 10%, the net present value is $10. Okay, so I have a liability of $10. I have to have assets whose value is also $10, and then everything's fine. But if the interest rate keeps dropping, notice that the net present value of my liabilities are going up. And in fact, every halving of the interest rate is a doubling of net present value of the liabilities. And that, by the way, that continues down to 1%, 0.5%, 0.25%, 0.125%, and so on. That you keep getting this doubling. So the the pension fund operators find that there's a shortfall every time the interest rate falls. There's a shortfall of capital. Now, normally what you should do in a pension, if there's a shortfall of capital, is you go to the pension sponsor, the employer, and say, please pay out more money. Well, it's politically unfeasible. Go to the taxpayers and say, you have to kick in even more money for these union guys. The taxpayers balk at these kinds of things, and rightfully so. My sympathies are with the taxpayers more than they are with the pension fund. And so then that forces the pension fund operators to, take on leverage and buy assets that they have by no means should ever be putting in a pension fund. And this gets to a point that I've been making recently now. There's a point from the Austrian School of Economics that I think is certainly under discussed amongst the Austrian school, and I think completely unknown outside the Austrian school. And that is, it's not that Powell is causing damage with his policies now. That's the wrong way to look at it. The damage is inflicted during the boom, which is a false boom. On the way up is when the damage is inflicted. The bust is simply accounting. It's the reckoning catching up to the reality of what's already been done. So the capital has already been siphoned out of the pension funds and everywhere else. And now you get a small rise in interest rates and suddenly, woe was us. Look at all the damage. Yeah, that's the damage that's been occurring over decades. So I'm not a pension fund analyst. I'm not saying this based on having studied all their balance sheets and read all their footnotes. But I would assume that if you said all the pension funds, defined benefit pension funds, are insolvent, if that turns out to be wrong, it wouldn't be wrong by very much. And it's not because they're dishonest or bad people that are running them. It's because there is no good way to run them in a falling interest rate environment. 4 decades of falling interest rates is enough to wipe them all out. So, the question is, how long can they continue? You mentioned Rick Rule earlier. I think he's famous for saying people confuse imminent with inevitable. I'm making a case that their collapse is inevitable, but I have no idea whether it's imminent or not. And I do find it telling that the pension funds had a crisis in the UK before there was any crisis in the US. So the US, the crisis will hit us last. Yes, eventually all the bad things will happen that everyone's predicting, but last in the US. And in the meantime, the rest of the world is basically feeding their capital into the dollar system. And that is going to make things good in America, or seem to be good anyways, for much longer when, real misery sets in other places.
On that last point about the rest of the world feeding their capital into the dollar system, there's been a marked trend over the past, I'll say, year or more, you could say several years, of this rising center of gravity or critical mass in the East, call it the BRICS Plus or OPEC Plus nations, uniting together to say we're going to come up with system structures, methods of payment and settlement, et cetera, that are based on real value, tangible goods, commodities, et cetera, and not based on debt, and basically pivoting away from the dollar system. Not entirely yet, but significantly, brewing storm clouds there and actually putting together agreements and alliances and mechanisms. What are your thoughts about that phenomenon, this East-West split, or some people call it Bretton Woods 2 or whatever, as far as the increasing or accelerating the risk to this unhealthy U.S. dollar debt-based system in the West?
I don't think there's any other paper currency that can come remotely close to replacing the dollar. Number one, just in terms of the flows, the liquidity, the size of the market, there's nothing else. Even aside from which, does anybody really want to be a creditor to Putin or Xi, let alone, Brazil, India? These are not creditworthy places. They're very opaque, very Byzantine systems, particularly in India. So I don't really see anybody wanting to hold that as a currency. I wrote an article, I guess it was about 8 months ago now. It was something like gold, oil, and the ruble walk into a bar was, I think, the headline. And I was talking about this idea of what are goods going to be priced in and what is going to be used as the medium of exchange. And the point of the article was that we should look at the base unit of economic calculation separately from, or potentially separately from, what is the unit of finance. So let's say you're in Brazil and you want to build a $2 billion project to mine, I don't know, potash or whatever. I don't know what they mine in Brazil, but I know there's mining there. What are you going to borrow? I mean, can you really float $2 billion worth of bonds denominated in real? And here's my point. You're still going to say $2 billion worth of bonds. The world is not thinking in terms of real. They're not going to say, oh, that's 17 billion real. They're going to say $2 billion worth of real denominated bonds. So the unit of economic calculation is the dollar. The unit of finance is the dollar. You're not going to raise from the external markets outside Brazil. You're not going to raise $2 billion to finance a potash mine in real, because nobody wants to be a lender of real. And then finally, there's the means of payment. So in my article, I talk about, suppose you're just busy, in work and business and whatever, and family, and your front lawn is overgrowing, and the homeowners association is sending you letters saying you really have to cut your front lawn or else we're going to fine you. And some kid comes knocking on your front door and says, I'll mow your lawn, and I want to get paid one box of ice cream sandwiches, which is 8 ice cream sandwiches. Does anybody really think that the ice cream sandwich is threatening the dollar or replacing the dollar? No. You look at the price of the ice cream sandwich and you realize that a box of them is about the $10 that the kid should get paid to mow the lawn. It's a reasonable ask. And you say, sure, I'm happy to pay you $10. And it's just that he wants his $10 in the form. He wants you to do him the favor of going to the store and getting ice cream sandwiches because his parents don't approve of him eating so much junk food. And so if he had the $10, it's not fungible for him to buy ice cream sandwiches. So he'd rather get it from you. And then, of course, he has to eat them because that's the summer and they're going to melt if he doesn't. So he does that. But the unit of economic calculation is the dollar. The proximate means of payment, medium of exchange, is the ice cream sandwich, but not really. It's really a dollar transaction. And I think that's kind of a framework of how people should think of these things. So, are the BRICS countries doing anything interesting? Yes, to the extent that they have commodities to export. We're in a world that is hungry for commodities, particularly potash right now, and obviously particularly energy. If you can liquefy the natural gas, Europe is desperately starving for it, and they're willing to pay huge premiums for it. Does that mean your currency is going to go up or whatever? Well, not necessarily. It's a dollar world, and there is no way to. It is what it is. It can't be rewired, that way. It is what it is. Whether you think that's a good thing or a bad thing is a different story. But first, just look at the facts and look at the science of it.
Well, we're going to have to circle back more. I see we're up against the clock here, so we're going to have to wrap. But I'd like to get into that last point. You mentioned using gold as we'll see what gold did in the bar because we didn't get a chance to hear that part of the story. But I really appreciate, we always have these very thought-provoking discussions and the time just disappears. So we're going to have to do this more and soon. So Keith Weiner, the CEO of Monetary Metals, remind people where they can find out more about your company and what you do, all in 1 minute.
We pay interest on gold in gold and silver also. Monetary-metals.com is our website. Most of my work is published there.
Thank you, Keith, for joining us here again on Liberty and Finance.
Thanks for having me.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.